Welcome back to the channel. And as always, if you copy trading, you're an absolute moron and you deserve to lose all your money. So today we're going to look at a long idea for a stock called FTAI Aviation Limited, ticker FTAI. And as you can see, this company has been doing quite well over the course of the last 2 years. And I do believe that this trend is going to continue for a good while and potentially even accelerate. So what do? They are an aviation parts business and they have two segments. So they own and acquire aviation offshore equipment for transportation of goods and people worldwide. So they have two segments, leasing, which is leasing aircraft and engines to airline and other aviation operators, and the aerospace product offering, which is engine maintenance, repair, overhaul. So in terms of the revenue breakdown, aerospace and products is just standing below 60% at the moment, with aviation just a little bit over 41. However, the aerospace products segment has been increasingly contributing to EBITDA. So this segment is reaching 40% of their EBITDA as of Q1 2024, up from 22% in Q2 2023, and is expected to continue growing in terms of EBITDA between 325 to 350 million this year to 700 million in 2026. In other words, it's going to double in a couple of years. And again, that's EBITDA, not revenue. So what we're seeing here is an acceleration of not only the revenue, but also the profit margin of the company. So if we have a look here at the results, we can see that in terms of the revenues, they have been accelerating rather rapidly. And in terms of the EBITDA margin, let's go. Yeah, so you see the last quarter, the acceleration of revenue was very good. But we also see that over the last few years, again, compared 2022 to 2024, the gross profit margin has significantly increased. And why is that? Well, the company is at the moment in a very competitive market position. There has been issues with new engine types that are keeping older aircraft and engines in service for longer. So in other words, they have to be maintained and repaired more often than they used to be. And there have also been supply chain constraints in the industry that have increased demand for the kind of turnaround solutions that they provide. This is one of the reasons why they're so competitively positioned in the market, because when you look at who else is doing what they do in the sector, yes, there are a few peers that we can turn to, but none of them really provide the value add comprehensive 360 value prop that they do. So there are a few companies that we can look into as competitors, but again, we're really just trying to get an approximation here because there's not like an apple to apple, and we have a few. So when you look at, for example, Boeing, you can see that FTAI is in a much different position as a multiple. We have WSO as well, and we have Lockheed Martin, where they acquired one of their businesses recently. That's going to enable the company to become more efficient. We also have Helmet Aerospace. These are larger market cap companies that are not going to be growing as much, right? They're very established. They have a very large customer base. But here's the interesting thing, right? This company is already selling at a premium compared to all those companies. So the company is selling at a premium compared to the sector, and the revenue growth and earnings growth is projected to grow at a much faster rate than its competitors. So that's one of the reasons why we like to look at this sector. Now, in terms of their uh, competitive position, I mentioned that they are expected to grow the revenue and profit. At the moment, they are growing from around 50 customers to a potential pool of 300 over the next few years. So that means that in terms of their total addressable market can grow around 6 times. And each customer, of course, is a large player, which represents a heavy contribution to top line. But as well, I think that there are some changes taking place into the sector that is going to contribute to multiple expansion for this company. And the reason for that is because they are engaging in PMA, Part Manufacturer Approval. So FTAI has received approval for at least one PMA part so far, and this has been installed in 15 engines already. Now, the company is working on getting approval for additional PMA parts. Okay, that is expected to contribute between 15 and 20 million of EBITDA in 2024. So the EBITDA in 2024 is going to be around 900 million, right? So we look at that uh, in the projections. We see that EBITDA is going to be around 900 million. So 15 to 20 million, yes, it is not huge. However, it will trigger them competing with the OEM parts, the official manufacturers, the original manufacturers of pieces in aviation. And at the moment, some airlines are waiting for more PMA parts to be approved before adopting them widely. And that's the kind of catalyst that we want to see. These guys expanding their remit into other parts of the sector and really start taking away market share from these larger players that we just looked at. In reality, there are benefits of these parts. So PMA is seen as a key strategy to reduce maintenance costs and improve margins. And airlines at the moment are very focused on cost reduction, which these FTAI parts represent compared to the original manufacturers. So I think because of that, we could see an acceleration on top of the tailwinds that they have going for themselves that have contributed to this outperformance in the last couple of years. There are still issues with the supply chain that they're capitalizing on. They're not expecting that to fade away until a few years. And because of that, I think that this trajectory that we have seen so far will continue for the medium term. So in terms of risks, there are considerations that are important from a management perspective. One of them is capital allocation because the company at the moment has a substantial amount of debt. So if we look at, for example, their net debt is somewhere around just below 3 billion with a market cap of 14. Now that is not big, but we have to take into account the capital structure. And the management commented recently in their last earnings call that they secure 800 million in a high yield debt deal. This is not a bad thing necessarily. The important thing is what the debt is being used for. But of course, it's something that has been watched closely by the ratings agencies, and their target is to stay around a double B rating score. So with that, we'll have to keep an eye on how management is deploying that cash in order to grow the business. Other risks that could take place are PMA approval by the regulators. Uh, this is something that really we'll have to keep an eye on the news. We'll have to see if many parts are approved, how fast they're being approved, and of course, uh, them being turned down by the regulator could represent a risk. And the last one would be the normalization of parts supply chain earlier than expected. This is supposed to happen somewhere between 2026 and 2030, but of course it could happen earlier than expected. So we'll have to keep an eye on that. But overall, the company seems in a pretty sound financial position. Their debt profile is fully unsecured, which gives them a lot of flexibility, and their business model seems to be not only thriving because of market conditions, but also evolving and encompassing more areas to take away market share from the competitors. That's why I think it's a company that is going to continue doing well. KPIs, they have been selling more and more module swaps. Like we said, they have grown their customer base. So from 2022, they have 26 customers up to 50 in 2024, and we discussed the potential up to 300. Their turnaround times have also been improving, and the maintenance capacity has been bolstered by the recent changes that they've done, as well as the acquisition from Lockheed Martin. They're also increasing their presence in Southeast Asia, which, as we know, is an area that is growing in terms of GDP and demographics. Onto the structure. I couldn't find anything exciting in terms of calendar. And they will be reporting earnings on the 25th of October. So if we have a look, of course, there's a big difference, right, between prices in October and November because there's no earnings in here. But a structure I think would work quite well would be go long the Novembers, 5% out of the money. So we're buying the 150s and selling the 160s. That assuming a 160% price target, which is in line with my expectations, would provide us with a 350% return. That's the price target that we're assuming with a 366 EPS over the next 12 months at a multiple of 45 times. Like we mentioned before, 45 times, not unheard of. There are other competitors selling at that multiple. So, for example, we could have a look at Heiko. Right here. So we could see FTAI coming back to those multiples, which reach actually over this summer. We can see how that trajectory, if I remove point here to make it a bit more visible, we can see how that trajectory is starting to resume. So that's the kind of move that I'm expecting here. Not a long shot by any means. Hope you enjoyed the video. See you soon.